Good afternoon, everyone. Thank you very much for joining our investor presentation update for 2024. Today with us, we have our MD CEO, Mr. Damit Pallewatta, our CWO, Mr. Sanjay Vijayamana, Chief Growth Officer, Mr. Bimal Pereira, our Chief Financial Officer, Anuradhita Alage, and myself. To start with, we will have a brief presentation by our MD CEO, and that will be followed up with questions that you may have. Over to you, Damit.
Thank you very much. Good afternoon. I am pleased to present the financial performance of the bank for financial year 2024. Let me start with from the revenue side, starting with the fund-based income. Starting comparison with the 22 and 23 in terms of interest income, as you all know, margins came under significant pressure. Interest rates have dropped at least by 50%. So that has resulted in our 304 billion interest income coming down to 240 by 21%. In parallel to that, we have also seen our interest expense being reduced from 186 to 130 billion, which is a 30% reduction in expense. Despite the reduction in expenses larger than the reduction in revenue in percentage terms, our net interest income recorded a marginal 7% drop from 118 billion to 109 billion for year 2024. As you will see, despite our interest income has dropped, we have recorded noticeable growth in the loan book of 117 billion, which has created a significant increase in the interest earning assets of the bank. We saw the first quarter a dip in the loan book, but for the last 9 months, there are close to about 144 billion growth in the loan book, which resulted in net growth of 116 to 17 billion for the whole year. At the same time, we saw the deposits have grown significantly. We have saw the deposits grown by roughly about 135 billion, of which the encouraging piece was the CASA. We saw close to 9% growth in CASA, so which helped the bank to a great extent in managing the margins, in increasingly depleting net interest margins due to sharp drop in interest rates. If you look at the graphs on the right-hand side, whilst it records the growth in the loan book, and the below graph speaks about the credit to private sector and PLR, the top left-hand graph indicates about the bank NII and the group NII versus the net interest margins. So the last quarter, Q4 2024, you would see a significant increase in margins as well as the NII in absolute number, which has an impact, one-off impact created from the ISB restructuring. So that has probably created a spike for otherwise maybe a stable growth that we were intending to record for the year. Moving on, if you look at the non-fund based income, we have seen net fee and commission income, which is primarily coming from maybe close to 50% coming from digital sources. If you look at the pie chart from the right-hand side, so increased by 15% from 16.5 billion to 19 billion. So we are happy that we are driving and striving for a cashless ecosystem. These numbers demonstrate that our commission income actually has derived maybe close to 50% from non-cash related transactions using either cards or digital sources. Then we have recorded a loss of 49 billion. Probably that would require an explanation that 49 billion represent the derecognition loss of 49.5 billion. When the ISBs were restructured, we have reversed 91.6 billion worth provisions that we have made against ISBs, which is little over 50%. So when the restructure happens, we were compelled to de-recognize that de-recognized loss was amounting to 49.5 billion. So as a result of that, as a result of the restructure, our profit before tax PBT was impacted positively by rupees 38 billion or around, with the impairment reversals and deferred tax asset coming into play, where we have charged 26 billion rupees by way of net deferred tax asset, so resulting a positive impact of close to 12 billion in PAT for the period concerned. So in terms of group wise, net group-wise insurance premium saw 17% increase from our subsidiary, that resulted in recording a 97 billion of non-fund based income, despite it is showing a reduction of 34%. If you take out the non-fund one-off incident of derecognition, perhaps we would have maybe coming close to 2023, irrespective of some of the commission income has significantly reduced, especially on the trade side. The standard fee has now settled down pre-COVID levels compared to 22-23, which recorded unusual height in the percentage of fees that were charged. Moving on with the impairment and the asset quality, I think we have recorded one of the best stage 3 ratios among the banks. We have recorded 1.88% net stage 3 ratio. At the same time, we have managed to increase stage 3 provision cover ratio to 74% from early 60s or late 50s. So that has resulted in we are on the basis of prudency, we are making adequate provisions to cover whatever the legacy NPLs that we would have carried through. So that has created us an opportunity to go and get aggressively follow recoveries and bring those assets back to performing categories or settlements. So once again, if you look at the information that is on the left-hand side of your screen on the reversals on ISBs, so 2023 we have made a provision of 36 billion, which has culminated up to 91 billion over the period to cover ISBs. We reversed that 91 billion in 2024, of which 49.5 billion was accounted as derecognition loss. So then for the new bonds that were issued, as you know, there are 3 types of bonds that were issued at the time of restructuring. One is the PDI bonds, that is for past due interest bond, for which we were required to recognize an impairment, which is the 1.5 billion that we have recognized in the impairment. Loans and advances, so we have increased our impairments by about 12.5 billion, which resulted in total impairment recording a reversal of 77 billion compared to the 44 billion charge that we had in 2023. What is important to note here is that impairment reversal is that positive impact is recorded in the impairments, whilst the derecognition has recognized under the revenue lines as other fee and other income. So then that has to be carefully analyzed and looked at when consolidating the numbers. If you look at the sector-wise breakup in the advances book, so we have a fairly spread asset book diversified into multiple sectors. We have seen stresses in some of the sectors have eased off, especially considering the tourism sector and the manufacturing sector. We have seen the consumption sector coming up, especially in terms of mortgages and the credit cards and the pawning businesses. We have seen increasingly coming up. We have seen the trade has increased. We have seen volumes are getting picked up. So as a whole, we have seen stage 3 ratio increasing and improving significantly on a well-diversified loan book. Moving on to the operational expenses. So the key expense that we have seen here is the personal expenses, especially coming from the increase in the personal costs by way of salary increments, and this is especially being the year of collective agreement, where once in 3 years banks sign based on the participation with the unions. So that cost has absorbed into 2024, and the other one is on the insurance costs that has increased to create that 17% increase in the total expenses. If you look at the cost income ratio, so we have made an adjustment to make it comparable with last year, taking out the ISB restructuring impact. As you would see, given the fact that interest income has depleted as a result of margins and the interest rates coming down and margins getting decreased. So then obviously the cost, the numerator has increased, decreased as a result, increasing the cost income ratio to stand at 37.2 for the bank compared to 29.9 that we have recorded in 2023. For the group level, obviously it is increased from 40 to 48%, given the same impact which is created by the ISB restructuring. Coming on to the taxation and the profitability, tax have largely impacted due to the fact that deferred tax asset has been charged back. So as you see, the profitability or almost profits have been doubled at the bank level, and almost 90% increase recorded in the at the group level. That has resulted in income tax expense almost doubling, increasing by 188% to 39 billion from 13 billion, which added a significant cost to the bank. If you look at bank level, your effective tax rate has increased from 52 to 58%, which is contributed significantly by the deferred tax asset charged into tax expense this time. So moving on, in terms of soundness indicators, bank has recorded strong capital ratios as well as liquidity ratios. As we can see, the tier 1 capital requirement against 13.5, we have recorded almost 19.5%, and against a tier total capital, our bank level capital adequacy ratios at almost 24%, 23.9% versus the required regulatory levels. Liquidity ratios, we remain extremely liquid both in dollars and LKR. LKR, we are 292% versus the required 100%, while all currency we remain at 330% versus 100%. So the graph, the right-hand side below, indicates that we have started to grow the loan book maybe third and fourth quarters, where the loan to deposit ratio was extremely low at 65%, and now beginning to increase because we have started to expand the loan book. Coming on to the DuPont analysis, so our ROEs at group level remain at 18%, but if you look at the bank level, maybe it's slightly higher than this, contributed by reduced leverage multiplier of maybe around 8.99, with an increased ROA of 2.11. So this increased ROA is contributed by net interest income of 5.16% and amplified by the impairment reversals versus the charge that we had last year. And despite slight increase in the operating cost with significant increase in taxation, which is negated by the reversal in impairment, we managed to, as a group, record significantly higher ROEs this time. So, but we need to be mindful, this ROE increase is contributed by the impact of earnings and the impact of ISB. So then in future ROEs will normalize where the industry stands, but this year we are standing very looks very sound and high in terms of ROE. So moving on, would like to point out few key highlights what we have done during the year. So we had a plan. How do we diversify our revenue streams? Because we have seen next couple of years going to be growth years for Sri Lanka. Economy is expanding. We have seen opportunity in the investment banking space because there are a lot of opportunities for debt raising, capital raising, plus supporting businesses with the equity side as much as a bank we do on the debt side. So then we offered the balance 50% stake to buy from a DFCC bank, which the transaction completed in early January, and we rebranded it as HNB Investment Bank, now as a 100% owned subsidiary, which is a key establishment for HNB after maybe 16 years of joint venture ownership. Now we have brought it back to HNB as a fully owned subsidiary because we have seen immense opportunity for HNB IB to support the growth that the economy is looking for, in addition to supporting it as a bank from the loans and the debt side. This investment bank is supported by a 100% owned subsidiary in the stock brokering space and the security space. And in addition to that, we have a unique business proposition on the venture capital with Lanka Ventures PLC, which is a listed entity separately. So that will help, especially the SME front and the tech front, for businesses to come up as we venture into investments in those companies that are coming up. Moving on to key awards and recognition. 2024 was a very, very significant year for us. We continue to record good recognitions throughout the year. So we have been awarded as the best bank in Sri Lanka and best bank for SMEs in Sri Lanka by Euromoney, which we consider as a good recognition because our work in the SME space, which is roughly about 26 to 20% of our loan book, which represents and significant amount of staff we have deployed in that front. So we got the due recognition to categorize as the best SME bank in Sri Lanka. And also Indian Chamber of Commerce, for the second time at the award ceremony, they had categorized and awarded HNB as the best bank in Sri Lanka. And the jewel in the crown is for the 15th consecutive time. The Asian banker has crowned HNB as the best retail bank, which has, looked at the multitude of offerings that we have made for individuals, including in the digital space as well as in the conventional banking. The Asian Bank also awarded us as the best automobile financing in Asia Finance, which assures and our leadership in the leasing, which is by far the largest lease financier in the country, maybe by about 80% ahead of the second competitor in the leasing market. We believe 2025 bring a lot more opportunities with the vehicle market opening for imports. We have already in the market with some novel products and offerings for us to facilitate whoever who is willing to own a vehicle in this country. And more importantly, we have once again been identified and recognized as a market leader in trade finance services by Euromoney. So we have the largest trade finance franchise in the country with largest number of accredited documentary credit certified people, which helps us with 700 overseas financial institution relationships managed by our FI unit, supporting the clients in any country doing a transaction as the most affordable rates, because we have the capacity to negotiate those transaction costs with those countries with the network of the relationship that we have with FIs in those countries. And also we won the Gold Award for the Bank of the Year for Customer Excellence in Excellence in Customer Convenience at the Lanka Innovation Awards. We are looking forward to this week's ceremony as well. We are hopeful that we will continue to win the awards because our app has rated one of the best in both app stores, and it brings convenience to customers in facilitating their transactions. There are a lot more. We thought these are the key ones that we should list and present to you today. Looking forward that 25 is going to be a fantastic year as well, with the economy expanding and banks have, getting ready to support that growth, especially with the multiple strategies in place to support that national cause. Thank you very much. Priyanka, over to you if you want to take any questions.
Thanks, Amit. You may basically come out with your questions or type on the chat box.
Hi Priyanka, if I may, this is Bimani here. Just want to if you can shed some light in terms of this year's credit growth and which sectors are the banks essentially focused on in terms of disbursements, and particularly touching on the vehicle importation side and how the demand has been on that side.
So thank you very much for that question. So we are focusing on maybe about 4 sectors. Increasingly, we have seen agri sector is something that we are focusing maybe differently this year. We have seen a lot of opportunity for agri innovations and bringing value addition to agri produce. So we have from the grassroots level at microfinance coming into SMEs and emerging corporate, as well as large corporates. So we have those across the value chain businesses which deal with agriculture. So we have focused a little bit more on the agriculture and hopefully that can see results for the economy as well. Then the second is manufacturing and the export-oriented manufacturing specifically. We are very keen to work with them. There are expansions, there are technology transfers and the equipments that are required. So we have seen slightly an upward movement on capital expenditure because all this time we have seen working capital and day-to-day operations running, but since of late we have seen people are moving into maybe import new machinery, expand capacity, increase building. So that is a good sign. So then country will benefit from that. We want to be part of that journey as well. Then the third area is healthcare and related businesses. We see there is enough opportunity for us to come in and support that growth, and then the education and the related areas, another one. And we'll see construction sector slowly coming up, is still not out of the woods. in case if picks up, satisfactorily, we do not hesitate to go and support the construction sector. We are already working with, key construction companies to support privately funded projects. We have not seen the government projects starting yet, or the multinational funded projects taking off the ground. So we are quite happy to look at such projects if that makes viable and affordable sense to the bank.
So there's a question on stage 3 provision cover. Where I think Isuru is asking, are you comfortable with your stage 3 provision coverage moving forward, or would you expect there to be sizable stage 3 impairment during 2025?
So that's a good question. If you see, almost 75% of stage 3 advances are covered by provisions. So what we anticipate in 2025 is, so whatever the legacy NPLs that we carry, even with collateral, if at all, if there can be timing delays in realizability, we have made on the basis of prudence a provision covering such debts, including taking into account the time value of money. So therefore, we don't anticipate a significant increase in stage 3 provisions to come this year. Even the stage 3 provision coverage, I see very little leeway for us to further improve and go and increase it to maybe beyond whatever the levels that we have. Our focus this year is, as much as possible, bring the stage 3 advances back to performing categories, or make sure that we recover or get into a settlement or restructuring plan. So slowly those businesses will come out of trouble and will be able to service their debts going forward.
So there's another question asked, what caused jumps in personal expenses 2 quarters in a row? Has there been any bonuses given during September or in December?
So usually December, we are not paying bonuses in December for executive staff. Usually those bonuses are paid in March. Our appraisal cycle is January to December, and we do the formalities, and usually the bonuses are paid in March. There are no bonuses paid in September. December bonuses are only for staff cadre and junior executive bonuses, which are, part of the budgeted expenses. We have not made any additional bonuses during September and December. The expenses increase that you would see is predominantly coming from the collective agreement pay increase that we have negotiated. Every 3 years that agreement is negotiated. This year is the first year where the bulk of the expenses are accounted for. Next 2 years going to be maybe much smaller increments coming from the collective agreement.
So the next question is, any views on the industrial credit growth in January, which recorded a negative? And in HNB, how was the loan growth in January and February?
I'll start from HNB's loan growth. January is usually a flat month, or maybe recording a slight contraction in loan books if you look at across the industry, which is recorded this year as well. Up to February, we have seen a slight loan growth. We have seen demand for credit is picking up. Some of the proposals that we have evaluated, which might get a little bit of more time for from the evaluation and approval to disbursements. So therefore, my assessment is actual credit growth will happen maybe from March, or after New Year, it will start to pick up in a much more steeper manner than for January and February. I don't think it's a good proxy to look at January and February credit growth. to understand how the market and the credit demand would behave.
I think Damit has already answered the second part of the next question, but a little bit on how the vehicle imports would impact credit growth.
Vehicle imports.
Yeah, so on the vehicle imports, I think we haven't seen the type of demand that was expected in terms of the overall hype and sort of the government's initial forecast. But there has been a fair amount of transactions, LCs that have opened, and we see that momentum building. But it's certainly not to the high expectations that were initially forecasted by the government. There's also a little bit of, we feel, a wait and see sort of attitude from the customers just to see whether there will be some changes in taxes. But nevertheless, all our customers that were involved in the vehicle imports, we have supported and basically looking forward to opportunities that are there in the market.
So the next question is on concerns that have emerged about potential negative impact from loans dispersed to Navalok and SoftLogic Holdings. What are your thoughts on same?
I think that's a very timely question. Thank you very much for raising that. So maybe last 2 or 3 days there were kind of malicious messages roaming around saying that it has impacted adversely. So I think if anybody looking at the numbers would understand what is the status of the balance sheet and what is the impact that this kind of a debt can do to a large balance sheet like HNB. So to start with, I would like to say this Navalok and SoftLogic debts are not only with HNB, it's across the industry. There are with multiple banks. The second point is on the basis of prudency. I think whatever that numbers that you have seen in 2024 would have taken into account or taken the impact, if at all, if something would have to be taken on, and that was accounted for in 2024. So therefore, we didn't even take any action to make a statement because the type of the message being circulated and the allegations that were presented to actually doesn't require any explanation because the reading through that you'll understand those are baseless and doesn't make any sense at this moment of time unless there are any different agendas behind it. So what I would say at this point of time, so we don't anticipate any negative impact from Navalok and SoftLogic Holding Group's debts to P&L. If at all anything to be taken as a negative impact, it has already been taken and accounted for. Last year's profit was declared after taking that if at all, if any impact to be taken, that is fully taken. So therefore, there is nothing to worry. There is nothing that we need to further look at in any of these debts. So therefore, we would strongly say that concerns are baseless. So we are not intending to make any statement or disclosure because those itself should realize, looking at the balance sheets, those are worthless making even a statement.
So the next question is, are there any upcoming capital raising plans to strengthen the capital base of HNB Finance as the continuous lending growth has put higher pressure in HNB Finance capital ratios?
Yes, we are going for a rights issue. So that will be completed soon. So that will support us. Right. So it will support us taking the capital ratios to satisfactory levels. So HNB has maybe 3 types of subsidiaries. One is one in investment banking I just spoke of during my presentation. where we latch on to the future in that you will soon see that we are coming up to the market with multiple propositions. The second one is on the insurance subsidiary, so which is growing faster than the market average, and you will see once again insurance company is doing completely differently in the next 2 to 3 years to come to capitalize the market. So third one is the non-bank finance institution that we have, which is the HNB Finance, which helps us to reach the segments which as a bank we can't reach. So therefore, we are committed to support HNB Finance wherever that is required. So if the continuous lending growth is there, if that support is required, I don't believe that it will put pressure on HNB capital ratios, because we would support them wherever necessary to make sure that their capital ratios stay comfortable going forward. There will be multiple avenues, if at all, if we need to raise capital, but as it is now, we are comfortable with what we have, and we should be able to maintain the growth momentum. And if at all the support is required, that can come from us as well.
So linked to that, there's another question on HNB Finance asset quality levels on the NPA ratio and the stage 3 coverage. Amit, would you like to take?
Yes. So I think that's a pertinent question. So if you look at maybe 22 and before advances, so that contaminates the entire NPL ratio of HNB Finance. If you separate your asset quality of the debts that have been booked after maybe 2023 first quarter, now which is almost about 8 quarters, and prior to that, so whatever the new advances that are booked and which is growing and increasing, is showing maybe around 1 to 2% of NPLs or stage 3 compared to significant stress that was created to the segment that they are exposed to during the crisis period. So if you really look at where the new advances are booked and where the books are grown, and which segments and the stage 3 ratios that we have recorded, I think we can reasonably be comfortable the new advances and the loan book growth coming from right risk levels, and we will be able to continue to improve the stage 3 ratio going forward.
Are there any further questions? The next question says, would the focus of the finance company shift from microfinance and gold loan to leasing going forward? That's already.
So I think it's a mix of products that we have in the finance company. So focus of the finance company shift from microfinance and gold to leasing. So leasing is anyway there. So that's what I explained. The 3 subsidiaries, we have the investment bank, insurance, and the finance company. The finance company would be useful in a larger organization like HNB to reach out the segments that which we find it's maybe not within the risk framework or appetite to reach. So then they will continue to engage in microfinance, they will continue to engage in gold, and as a proposition they will continue to engage in the leasing business as well. Maybe the bank, as HNB, we are the leader in the leasing business with the highest receivables in leasing. We will continue to do that. Then HNB Finance may be catering to a different market, different types of vehicle. They will continue to grow on their chosen segments for customers. So then both will stay in tandem. There will be no shift in the focus on the diversified product portfolio that we manage in HNB Finance.
So again, related to HNB Finance, are there any strategic alignment between HNB Finance and HNB PLC in terms of product offerings?
I guess I have answered that question already, Priyanka.
Yes. So the next one is on net fee income. What was the reason for the impressive net fee income growth in the last quarter? And do you expect the net fee and commission income growth to continue in 2025?
So in terms of net fee and commission income, we've seen considerable growth in terms of our digital channels, the ATMs. Those channels have really contributed to this growth, and some of the commissions we would have recovered towards the year end, so that had already contributed. So going forward, also our focus, like Damit mentioned during the presentation, our focus in terms of digital channels would continue, and we hope to increase our penetration in those areas.
Are there any more questions? So if there are no further questions, thank you very much for joining our fourth quarter update. We look forward to meeting you again with our first quarter 2025 update. Thank you. Have a pleasant evening.
Thank you very much.